Hey everyone, this is Mike Minter with Financial Synergies, and it is Monday, November 13th, and we are looking back on last week, of course, November 6th to the 10th, and this is your market in minutes. And I apologize for the late start here, guys. Things got away from me today and just didn't get around to the videos as fast as I wanted to, but we'll jump right in and we'll try to move along relatively quickly here. So 5-day performance last week, good week in general. As you can see, the Russell 2000, which is a new data point I'm putting on here, and I think we'll monitor this going forward. I talked about it last week, but small cap stocks are represented by the Russell 2000. It's not the only index, but it's one of the more widely used. And I thought that might be nice to kind of see what those things bring to the table. And it is a relatively spicy index. The small capitalization stocks are, in general, a little bit more volatile. You can see that they were actually down quite a bit last week, whereas the week before, small cap stocks were up about 8%. So, I mean, they can bounce around pretty dramatically. So last week they had a bad week. Now we'll tell you more about small caps here in a minute, but it's been a rough go for small capitalization stocks in general. But you can see across the board last week was actually a good week overall. Foreign was down. The EFA here was the foreign developed markets was down, but all across the board for domestic was pretty good. Let's turn our attention to year to date. Of course, still a very healthy year. Everything across the board is up except for those small cap stocks, which we just talked about. So, small cap stocks in general are more sensitive to a couple things: the economy and rates. And when rates are rising, they tend to be affected more dramatically. So they think about a small cap stock, and they don't have the access and the wherewithal that a lot of large capitalization companies have to credit and things like that. So they tend to be more adversely affected by a rise in rates, and they're more economically sensitive. So the last 18 months or so, in recent history, it's been rough for small cap. There's no sugarcoating it. But long term and in general, they provide a very good return enhancer and also diversifier. So although they're having a tough go of it this year, still a great asset class. Of course, think about it. It's kind of the backbone of small business America. And these are not little mom and pop stores per se. They're still what you and I would consider pretty large companies, but compared to, Apple, Microsoft, they're teeny tiny. Another thing I'm going to start doing is bringing in relevant rates. And this might change based on the environment, kind of what we want to focus on, but relevant rates, things that are good economic metrics. And so I thought we would just start monitoring these as well. I mean, I always monitor them anyway, but I thought I'd just bring them into the report to show you guys. So what we have right now are the 30-year treasury, the 10-year treasury, and the 2-year treasury, and the corresponding rate. This is not how they did last week. It's not a performance number. It's just saying this is where they sit today. And then I thought the 30-year mortgage is always nice to get a handle on. And that's an important number for a lot of different reasons, not only home ownership, but it's a huge part of the economy. If rates are too out of the reach, most Americans, then that's really going to hurt home buyers, which it has. It really has. So we've got the 30-year treasury at 4.8, the 10-year at 4.7, and the 2-year at 5, and the 30-year at 8%, which is still a little hard to swallow for all of us that have kind of gotten used to hearing 4% mortgages, even on down to, my gosh, at some point it was 3, maybe even less than 3 on a 30. 8% is it's a big number. It's a big jump. So hopefully a lot of you locked in at the lower rates and have a very favorable mortgage rate, which I think is part of the problem in the home building or the home industry right now, is that a lot of people they're locked in and happy and don't have any desire to now go out and buy a new house and potentially lock in a much higher rate. So that's a real problem. It's kind of stalled the housing market to a degree. So back to the treasury rates here, you can see the bonds. So this is, again, kind of indicative of that inverted yield curve we've talked about a lot. So the 30-year is actually yielding less than the 2-year, which is lopsided. That doesn't make any sense from a risk standpoint. So, and it's not normal. So that it will revert, of course, but it's still on its way there. So it is lessening. It's less inverted now than it was, but you can see that the 5 over the 4.79, it doesn't make a whole lot of sense in a normal environment. So let's take a look at what occurred last week. As we said, stocks did actually round out the week firmly in positive territory, but it wasn't always that way. So it was a very kind of light news week, but stocks added the gains of previous week's rallies, which was good. This was helped by stable bond yields. The advance did not go smoothly, so they were basically erased on Thursday by the combo of 30-year Treasury bond auction that saw very low investor demand, and that sent bond yields higher. Also, there were disconcerting remarks by the Fed Chairman Powell that disappointed investors. A lot of people harboring hopes for the conclusion of the Fed's rate hike cycle. It's not a foregone conclusion that they won't pause or stop hiking rates. They very well could, but some of what he said was just kind of more of a cautious stance. So we'll talk more about that. Stocks rebounded strongly Friday as investors reconsidered Powell's comments, which is often the case, and bond yields retreated, leaving the rally from October lows intact, which is good news. Let's take a look at what Powell said. So Powell speaks. So gave a presentation to a gathering at the IMF, the International Monetary Fund, and Powell said that he and other Fed officials were encouraged by the progress in bringing down inflation, but he was not confident that the Fed's restrictive monetary policy stance was sufficient to achieve the Fed's target inflation rate of 2%. So doesn't mean that they won't. He just was not confident. Again, he's never going to be exuberant and jumping for joy. That's not his job, and that would not be taken very well. But he's just cautious. He's probably a little bit more cautious, I think, in his tone than people wanted to hear. So is really where that's coming from. The comments, which followed the Fed's 2 successive decisions to pause on fresh interest rate increases, emphasize that there's a long way to go to achieve that goal, that 2% goal. So the Fed's committed to doing what's necessary to reach that target, whether that's through additional rate hikes or keeping rates higher for longer. So we'll see. Doesn't mean anything really, because things could change this week as we've seen. But just a little bit more cautious than I think people wanted to hear on that. So let's take a look at what is on deck for this week. So we've got some key economic data coming in. So Tuesday we've got CPI. This is your consumer price index, the main inflation indicator. Wednesday we have the producer price index, another inflation indicator, and retail sales. So big week for inflation. Thursday we have jobless claims and industrial production. We'll be watching jobless claims. That's a big one these days. And Friday housing starts, another big kind of economic mover. Not a huge week for earnings. Companies reporting earnings Tuesday, the Home Depot. Wednesday, Cisco, Target, and TJX. Thursday, we have Walmart, Applied Materials, Palo Alto, and NetEase. So that rounds out what is on deck for this week, folks. I really appreciate your time and you sticking with me here. Again, I apologize for the late release on this. Try to be better next time. Just kind of got away from me. So here is our contact information. Anything you need to get a hold of us. Subscribe to our YouTube channel if you'd like. Get the videos as they come out. Always helpful. Sometimes we don't do it on the blog, so you can see everything. And I will leave you with some light reading disclosures. And other than that, folks, we'll see you next time. We'll report back on what happened this week as always. Hope you have a great rest of this week. Thanks, guys.